Good afternoon, everyone. Welcome to our Introduction to Cost Segregation and the Impacts of Tax Reform webinar. We like to begin all of our webinars with a little background on our company. KBKG is headquartered in Pasadena with additional offices in Illinois, Georgia, New York, and Texas. Since 1999, we have successfully conducted thousands of studies nationwide. KBKG's team has performed studies on facilities ranging in size from 10,000 to over 1 million square feet, resulting in the deferral of hundreds of millions of dollars in taxes. We also have highly qualified engineering and tax professionals on staff. Our engineering department has extensive construction experience in reading plans and utilizing RS means and Marshall and Swift cost estimation techniques. Our tax department provides support for all cost segregation tax-related issues, including 1031 exchanges, AMT, passive activity, abandonment write-offs, and lease provisions. We are a preferred provider for thousands of CPAs across the country. Now we'll turn it over to our speaker.
Thanks, Beezer, and welcome everybody. I hope you're somewhere cool where you can enjoy this hour of CPE talking about cost segregation. I'm in a very warm place. We have a lot of 100-degree days here in the middle of Texas. But before I dive into the topic, let me just go over a little bit about my background. I'm a graduate of Texas A&M with an undergraduate degree in environmental design and a graduate degree in construction management. And I joined KBKG about 9 years ago to lead our Texas-based operations and do quality control reviews on cost segregation studies and fixed asset studies that we do. I'm proud to say that KBKG is very involved in the American Society of Cost Segregation Professionals, and that's the organization that's recognized as the primary professional organization in our industry. We currently have 8 of our staff that are certified members of the ASCSP, including myself. And I currently serve on its testing committee, and I've been a past chair of the education committee. All of the cost segregation reports that I review here at KBKG are ultimately signed and then certified with my ASCSP stamp, which is a symbol of quality to anyone else who might have reason to review that report. In particular, the IRS, although they'll never tell you that it's a requirement or anything like that, they understand what that certification means. So I think it's very helpful to have. I have close to 40 years of experience. I'm in my 40th year right now doing cost segregation studies. 20 of those were with the Big Four CPA firm. So these are our primary learning objectives for today's webinar. First of all, you should be able to explain at the end of this webinar what cost segregation is and how you can ultimately take advantage of it. You should be able to identify tax issues that need to be taken into account in conjunction with cost segregation studies. You should be able to discuss the potential impact of cost segregation on estate planning. Might be a surprise to some of you. And you need to be able to discuss the impact that recent tax reform has had on cost segregation and how cost seg opportunities can overlap with the tangible property regulations. So with that, let's dig right into it. First, let's talk about what kind of properties ultimately are good candidates and can qualify for cost segregation studies. As you see on the left side of your screen, really there's 4 types of projects that we see. Acquired property is probably the most common. Maybe 70% or more of the projects we do end up being acquisitions. But new construction comes in second. And it kind of makes sense if you think about it that there's a lot more properties existing out there than are being built at any one time. Every time a property trades or turns over, goes from one taxpayer to another, even though it's an existing property, that's a new property to that taxpayer in terms of setting it up on their depreciation records. So they set it up when they acquire it and begin depreciating it from that day going forward over whatever recovery periods are appropriate for that property. Cost segregation basically accelerates the depreciation of an asset. It doesn't increase or decrease the total amount that gets depreciated over time. It just reallocates the periods in which that depreciation is taken. A good indicator of the potential for a cost segregation study is going to be the amount of remaining basis that you have left in an existing property and how many years that are left to depreciate that property. Really, a cost segregation study should do two things, or several things. It should identify all the short life property that's eligible for accelerated depreciation, but it should also componentize all of the real property. We had the tangible property regulations implemented back in 2014, and as a result of that, cost segregation studies can now be leveraged to provide a lot more detail than they ever did before. There really wasn't a need before that. But this section of our webinar is designed to give you a high-level look at cost segregation. If you need to go into a deeper look at cost seg with bonus depreciation or tangible property regs, although we'll touch on those things, I encourage you to check out some of our other webinars that we have available online. Here we have an example of an acquisition of a $5 million office building. And without a cost segregation study, this building would just get depreciated straight line over 39 years. But as a result of a cost segregation study, the basis then can be segregated into 5, 7, and 15-year property. And so that results in an additional $1.2 million of deductions in the first year and an overall net present value of $330,000 over the life of the property. And here we see the same example visually showing that big spike of depreciation, the 100% bonus depreciation in the first year. Without the cost seg study, the full cost of the building just simply is recovered straight line over 39 years, as shown by the red line in this chart. And the purple line shows how depreciation has been reduced year by year for that same period of time, but you've got the big spike in year one. So basically in this example, 1.25 million is depreciated in year one, and that includes the 5, 7, and 15-year assets that all get the 100% bonus treatment. As you can see here, virtually all types of commercial and residential rental property are going to be good potential candidates for a cost segregation study. This slide is a general kind of table that describes what a cost segregation study might yield on average for different types of facilities. A big difference is going to be the amount of land improvements, which can vary tremendously just based on the topography or local zoning requirements. Depending on what type of facility you have and what type of functions are being performed in it and how extensive those land improvements are, your building could end up on the higher end or the lower end of the spectrum in any one of these groups. Section 1245 property is basically any new or used tangible or intangible personal property that has been or could have been subject to depreciation or amortization. That's the formal definition. Regulation section 48(1)(c) defines tangible personal property as any property except land, buildings and structural components of buildings, and land improvements such as swimming pools, paved parking areas, and so on. Tangible personal property includes all property other than structural components which is contained in or attached to a building. So this would include property like production machinery, printing presses, transportation and office equipment, refrigerators, grocery counters, testing equipment, display racks and shelves, and neon and other signs which are contained in or attached to a building. All of those items I just listed off come directly from the definitions in the regs. The picture you see here on the screen represents a typical retail store like most of us have shopped in. And based on my observation of what's going on in this picture, the items listed on the left are going to be potential Section 1245 tangible personal property that could be depreciated over a 5-year recovery period. In an industrial building where some type of manufacturing is going on, it's very common to see dedicated supply water and wastewater systems that support your manufacturing process. It's also quite common to see fume exhaust systems that support some kind of operations in that business. The manufacturing equipment also usually has dedicated electrical switchgear and distribution systems to support those items. There can also be an emergency generator or HVAC for special temperature and humidity requirements, or structural framing to support bridge cranes. We would consider all of these items I've just listed as an accessory to the taxpayer's line of business. These assets differ from those that are essential to the operation or maintenance of the building. Now, these phrases I just mentioned, accessory to the taxpayer's line of business, operation or maintenance of the building, these phrases are general concepts that have been discussed repeatedly in court cases over the years. And during a cost segregation study, we rely on our expertise in applying these concepts to determine which of those assets that are components of construction in the building can be treated and depreciated as tangible personal property. When referring to land improvements, most tax professionals are thinking of asset class 00.3 from Revenue Procedure 8756, which defines land improvements as any improvements directly to or added to land, whether such improvements are Section 1245 property or Section 1250 property, provided such improvements are depreciable. That's a direct quote. The asset class then goes on to give examples of land improvements like sidewalks, canals, sewers, wharves, fences, landscaping, and so on. For most taxpayers, the identification of land improvements is very beneficial because they have a 15-year recovery period and they are currently eligible for bonus depreciation. We'll talk more about the bonus eligibility later. In the picture on the right, you see a typical walkway in an office park. And as you can see, there are many land improvements to be identified there. Cost segregation should be one of the most common tax planning tools for taxpayers that invest in real estate. The study can be done in the year that the asset's been placed in service for sure, but it could also be done later in a year down the road, allowing the taxpayer to take advantage of the extra deductions when perhaps they're more useful. If done in a later year, there's no need to file amended returns. Instead, the taxpayer simply files a Form 3115 to catch up on all the missed deductions from prior years in the current year. A good rule of thumb for when it makes sense to consider doing a study is when the depreciable basis, excluding land, exceeds $750,000. However, for residential rental properties with depreciable basis between $150,000 and $500,000, we've developed an online software tool that can actually address those properties too very efficiently in a very economical way. And this slide here has a link to that tool. Well, let's talk about some of those tax considerations that I mentioned. When you consider doing a cost segregation study, it is important to remember the following. First of all, depreciation deductions will reduce alternative minimum tax. Bonus depreciation can apply to reclassified items in a cost segregation study of a new construction project. And thanks to the Tax Cuts and Jobs Act, now it can apply to acquired property too. In my 40 years of doing cost segregation studies, half that time bonus didn't exist. But when it came out after 9/11, it started out as 30% was the bonus rate. And that's gone up and down over the years. It's been up to 50, up to 100. It's gone away. It's come back. It was 50 for a long time. But never had it been for anything but new construction until the Tax Cuts and Jobs Act in 2017. So 100% bonus and applies to both new and acquired properties. Any unused deductions do get to be carried forward to future years. And when a building is sold, the taxpayer or seller has to recapture the depreciation taken on the tangible personal property. Accounting method changes are addressed with Form 3115, as I mentioned, which means you get to retroactively address buildings from prior years. Passive activity rules can offset the benefit of a cost seg study, and certain 1031 exchange rules need to be considered as well. When a building is sold, the taxpayer or seller must recapture depreciation previously taken on tangible personal property. So Section 1245 recapture is calculated at ordinary tax rates which leads us to recommend holding the property for at least 5 years when you're considering a cost segregation study. If you know you're going to sell the property in a couple of years, it probably doesn't make sense to go forward, but it's something we would definitely encourage you to consider and discuss with your tax advisor. When a property is sold, the fair market value of the Section 1245 property can be uncertain. The seller can minimize recapture by allocating more of the sale price to real property instead of personal property. And in many situations, if you think about it, personal property in the building may have little to no value at the time the building is sold. For example, carpeting that was put in a decade ago likely has minimal worth, especially if the new owner has plans to replace it. In this case, it will be appropriate to allocate only a nominal amount, if anything at all, of the building sale price to that carpeting. So a proper valuation of the personal property could possibly yield lower overall recapture tax. The Tax Cuts and Jobs Act created a new limitation on business interest expense, which applies to all businesses, regardless of their form, on the deductibility of net business interest expense that exceeds 30% of a taxpayer's adjusted taxable income. Well, the good news is that the Act provided an exemption from the limitation on interest deductibility for those taxpayers other than tax shelters whose average annual gross receipts did not exceed $25 million for the 3 preceding taxable years. Taxpayers that are considered to be in a real property trade or business have the opportunity to elect out of the limitation on interest expense deductions. However, the electing taxpayer in this example is required to use the alternative depreciation system for depreciable real property. And the ADS recovery is 40 years for commercial buildings, 30 years for residential rental property, and technically qualified improvement property was 39 under the Tax Cuts and Jobs Act, and will go to 40 under ADS. But thanks to the CARES Act that corrected that, qualified improvement property is 15 years under the general depreciation system and 20 under ADS. The result of that mandatory requirement to use ADS is that bonus is not available to the taxpayer in that situation, so no bonus for the QIP under ADS. However, the ADS requirement only applies to the taxpayer's real property, which QIP is an example of real property. So any personal property can still continue to be depreciated using the GDS recovery lives and receive that bonus treatment. The bonus depreciation rate was increased to 100% for eligible property that was placed in service after September 27th of 17, and the 100% rate continues through this year, through 2022. It's then scheduled next year in 2023 to reduce by 20%, so it'll be 80% next year, and it'll reduce 20% each year after that until it's gone. The bonus rates can be extended an additional year for long production period property and for non-commercial aircraft. To qualify as long production period property, an asset has to have a recovery period of at least 10 years, be subject to Section 263 Cap A of the Internal Revenue Code, and also have an estimated production period exceeding 1 year and a production cost exceeding $1 million. It must have also been acquired subject to a written binding contract that was entered into prior to January 1st of 2028. A couple of items to note here about bonus depreciation. When there is a step up in basis due to a Section 754 election, that step up can receive bonus depreciation as long as the new partner didn't have a prior depreciable interest in the property. If the taxpayer had a prior interest in a portion of a property and now acquires an additional interest in the same property, the additional interest can be bonus eligible, assuming all other criteria are met. And for a step up in basis that's due to death, where a property is being passed on from a decedent to an heir, in that case, the property is specifically excluded from bonus treatment. In 2020, the government signed the CARES Act into law, providing Americans and businesses economic assistance and tax relief. And although the CARES Act of 2020 didn't directly address bonus depreciation rules, it is legislation worth noting because of its effects on bonus depreciation considerations for taxpayers with qualified improvement property or Section 163J elections. The CARES Act provided that technical correction, that much needed correction for the depreciable tax life of QIP, as we mentioned earlier, going from 39 years to 15 years, and it made the correction retroactive for improvement property placed in service on January 1st of 18 and after. Prior to the CARES Act, the Tax Cuts and Jobs Act constrained the ability to use net operating losses to lower tax liabilities, and the Tax Cuts and Jobs Act restricted carrybacks of NOLs generated in years after December 31st of 17 and limited carryforwards to 80% of adjusted taxable income. That CARES Act, as I alluded to earlier, allowed taxpayers with NOLs generated in tax years after December 31st of 17 and before January 1st of 21 to be carried back to each of the 5 preceding taxable years. And in addition to the 5-year carryback, the CARES Act suspended the 80% limit on carry forwards, allowing NOLs to fully offset taxable income until the end of 2020. Qualified improvement property was introduced to us as part of the PATH Act way back in 2015 and was effective in 2016 forward. And as discussed before, several specific qualified asset classifications were removed as part of the Tax Cuts and Jobs Act, most notably qualified leasehold improvement property, with the intention that QIP would just replace all of them. Qualified improvement property basically are improvements made by the taxpayer to the interior of a building after the building was originally placed in service, and it must be made to commercial, non-residential buildings. These improvements cannot be an elevator or an escalator. They cannot be an expansion or components that are structural in nature. And the definition has some similarities to what you might remember of leasehold improvements from years past, but it's not. It does not have to be completed pursuant to a lease, and it can be for improvements made to a common building area. So it's sweeping a lot more property into the bucket that can be treated as with this special condition that we're calling qualified improvement property. Also, there can be improvements made to a building at any point after it has originally been placed in service. There's no 3-year-old building restriction like we used to have with leasehold improvement property. Theoretically, if you acquire the building on one day, an improvement you pay for on the next day could be qualified improvement property. Prior to 2018, qualified improvement property was recovered over 39 years and was 50% bonus eligible. There was that brief period in the final quarter of 2017 for which the regulations confirmed that QIP acquired and placed in service after 9/27/17 and before January 1st of 18 was eligible for 100% bonus, even though it's recovered over 39 years. And then thanks to the CARES Act correction, the QIP went to 15 years, effective January 1st of 2018. And so then you had the 100% bonus applicable to the QIP after that. There are certain types of property that are specifically excluded from bonus applicability. In situations where the taxpayer is required to use the alternative depreciation system, emphasis on the word required here, the bonus is not applicable. Examples of this include property that's used outside the United States, tax-exempt use property, and tax-exempt bond finance property. However, using ADS to determine the adjusted basis of a taxpayer's qualified business investment or the adjusted basis of a taxpayer's tangible assets for allocating business interest expense between expected and non-expected trades or businesses does not cause a taxpayer's tangible property to be ineligible for bonus depreciation. Also excluded is property that's primarily used in certain regulated public utility trades or businesses. This exclusion, however, only applies to property acquired after 9/27/17 and placed in service in tax years beginning on or after January 1st of 18. Another type of property excluded from bonus depreciation is property used in a trade or business that has floor plan financing indebtedness if the floor plan financing interest related to that indebtedness was taken into account under Section 163J1C. Dealerships are the most common example where you have floor plan financing being used, and for those dealerships where the operating entity leases from a related real estate holding company, the real estate company can still take bonus depreciation on the real estate. The regulations also provide rules that floor plan interest is not considered taken into account for a tax year if the sum of business interest income for the tax year and 30% of the adjusted taxable income for the tax year equals or exceeds that of the business interest as defined in Code Section 163J5. And that's a test that gets made annually. In order to be bonus eligible at the 100% rate, the property generally needs to be placed in service after 9/27/17, but before January 1st of 23. When you're determining the place in service date, the new regulations are generally the same as the former rules that were outlined in Section 1.168K 1B5. When buildings are newly constructed, we normally look to the certificate of occupancy date to define when that building should be placed in service. For acquired buildings, we look to the ready and available for intended use standard. If you think about it, it's possible to acquire a building that's not quite ready and available to use. Perhaps the interior is unfinished, or there may be plans to gut and renovate that interior in order to make it attractive to tenants. Once the building is ready and available for use, though, you can begin recovering the cost of it through those depreciation deductions. Self-constructed property includes property constructed by the taxpayer for its own use, as well as property constructed on their behalf. The property that is not considered acquired until the taxpayer begins manufacturing, constructing, or producing the property. There is an optional safe harbor that allows the taxpayer to determine the effective acquisition date as the date when 10% of the total construction cost has been incurred or physical work of a significant nature has begun. If more than 10% of that project was incurred prior to 9/28/17, then the old bonus rules will apply, including the old phase down of the bonus rate, meaning 50% bonus in 2017, 40 in 2018, and 30 in 2019. There's also a component election that potentially allows the taxpayer to bifurcate the project between portions that were completed before and after 9/27/17. As our examples show, this can enable a project that doesn't meet the safe harbor test to still qualify for the 100% bonus treatment for some of the project components. And we think that this is going to become important in the year ahead as we transition from 100% to 80%, and then the following year from 80% to 60%, and so on. Well, now let's talk about bonus depreciation in light of the 1031 exchange. There was a lot of discussion in our industry about the impact on 1031 exchanges. The proposed regs that were published in June of 2020 had taken a much more restrictive view of what might be considered personal property within a real estate transaction for a 1031 exchange. However, based on the final regs that came out in November of 2020, cost segregation should continue to be beneficial on both sides of a 1031 transaction. The final regulations clarify that nearly all 5- and 7-year property traditionally identified in a cost seg study is going to be real property from the standpoint of a 1031 exchange, and therefore completely eligible for that exchange. If it's real property under state law, then it's real property for 1031. So anything affixed to the building and not expected to move is real property. And this is a complete 180-degree change from the proposed 1031 regs that came out in June of 2020. The result is you can continue to defer those gains on 5- and 7-year property in a 1031 exchange, just like you did before the Tax Cuts and Jobs Act. It's important to remember that you must have an equal or greater amount of 5- and 7-year property in that replacement property to avoid recapture, though. So if you have 5- and 7-year property broken out on the relinquished property, you're likely going to want to do a cost seg study on the replacement property as well to get those amounts up where they need to be. With respect to bonus depreciation, it's important to remember that the bonus would only apply to any excess basis in the replacement property, not to any carryover basis. Okay, so picking back up, the grouping election should be considered if you have real estate that's actually being used by the operating entity and the same owner owns 100% of both entities. So this allows you to group the activities and use the losses from one business to offset the income in the other business. And under this scenario, the same owner with that $100,000 of income in the retail business and the $100,000 of losses from the commercial retail property will pay zero in tax. The taxpayer can only make the election to aggregate the activities when these entities qualify for grouping, and the election requires the attachment of a formal statement to the return. Cost segregation can be a useful tool in estate planning. For this strategy, let's start with some basic rules related to estates that involve real estate. When you have a building owner that dies and a property gets inherited that has appreciated, any gains that are built up during the decedent's life are just forgiven. The beneficiary receives a step up, which means the property's tax basis is reset to the fair market value at the time or date of death, and then depreciation starts all over from that point going forward for the beneficiary. And this provides an opportunity to apply a cost segregation study on the decedent's pre-stepped up basis, which creates a permanent tax deduction. I mentioned this early on in the presentation. This is the other example I wanted to bring up about a way to have a permanent tax deduction associated with cost seg. So to illustrate this, let's look at a building purchased by the decedent 6 years ago where the death happens in August of the current tax year. Since the original investment of $1 million is considered residential rental property, it's getting depreciated over a long life of 27.5 years, straight line. So by the time of death, the decedent will have roughly $728,000 of depreciation that he never got to deduct. The decedent will need to still have a final tax return prepared for that portion of the year that he was alive. And if you suppose the decedent had sold that property for $2 million before death, then there would have been a taxable gain of $1.27 million. But in our case, that doesn't happen because he still held the building. And according to the current estate tax rules, they forgive any taxable gains that were built up by that decedent. So the beneficiary gets that full step up to fair market value on the date of death, in this case to the $2 million. And the beneficiary now records that $2 million basis on the tax return going forward. Most CPAs and tax advisors already know that doing a cost seg study on the $2 million stepped up basis is a good idea, and it is. But many tax advisors overlook the time-sensitive opportunity to apply that cost seg study to the pre-stepped up basis. And this allows the decedent to claim even more depreciation deductions before the death, lowering the building's tax basis and creating a higher step up to the fair market value. The idea here is take as much of that unused depreciation before death as possible, since the heir gets a step up to fair market value regardless of the decedent's final basis. This strategy typically yields the greatest benefits for the estate because those deductions would otherwise be lost forever if they weren't taken on the decedent's last tax return. When we conduct a cost segregation study on the building as of its original purchase date, we identify the items in the building purchase price that should have been depreciated with shorter tax lives. So in this case study, our cost segregation study came up with $200,000 of things like cabinets and ceiling fans and appliances and electrical related to those that would all be 5-year property. It also identified $100,000 of things like parking lots, landscaping, and fencing that could be recategorized as 15-year land improvements. And since the decedent should have written these off quicker than 27.5 years, the IRS allows him to claim any missed deductions on his final tax return using Form 3115. In this study, when the decedent's final tax return is filed along with Form 3115, they claim those missed depreciation deductions of approximately $174,000. And as discussed, this lowers the decedent's building tax basis, but it's okay since the heir gets to step up to fair market value regardless of the decedent's basis. Because those deductions would have been lost forever, the result here is permanent tax savings that are just over $68,000. Now, I mentioned that this needs to be done on the decedent's final tax return, and that's because when a building is acquired in a tax year prior to death, in order to apply a cost segregation study, a 3115 has to be filed, and generally you cannot file a 3115 on an amended return. So it needs to be done with that timely filed final tax return. From the heir's perspective, they now get to step up the basis to the current fair market value, and then they begin depreciation all over again. And since they've already had a retroactive cost seg study done on the property, they can now have that study updated to reflect a new fair market value step-up basis, and that can be done at a very minimal cost. And this allows the heirs to maximize their deductions on the new basis. Okay, well, here is a way to recover some depreciation deductions that would otherwise be lost if a taxpayer decides to demolish a building that is currently being depreciated. If you have a significant remaining basis left in a building, a retroactive cost seg study could identify the 5-year and 15-year property and accelerate current year deductions, and whatever basis is left as building would then be treated like land and no longer depreciated. So this strategy doesn't work if a property is purchased and the building is immediately demolished. Thanks to the tangible property regs, there's a way to avoid rolling a demolished building's remaining basis into land. If the taxpayer anticipates a future need to demolish a building, then the building can be placed into a single asset, general asset account, or a GAA, allowing depreciation to continue even after that building's been demolished. And then later, when the new building is constructed and placed in service, the taxpayer will be able to take depreciation deductions on both the demolished building in the GAA account and the new building that's replaced it with normal recovery periods. The key to taking advantage of the GAA election strategy is to first carve out the 5, 7, and 15-year property from the real property. Later, when the building is demolished, the taxpayer immediately writes off the short-lived property. The real property continues to be depreciated in a GAA account, even though the old building was demolished. And if a new building is built, it too can be depreciated, even though you're still depreciating the old building that's no longer there. The current regulations also allow you to take a loss deduction when you remove components from your building. So for example, if you pay $50,000 to replace all HVAC units in your building with new ones, you need to capitalize that amount. And the $50,000 is then recovered over 39 years. However, you can figure out how much remaining basis is left in the old HVAC and claim that as immediate deduction in the tax year that this occurs. And this can be done on a go-forward basis. If you acquired an existing building and don't know how to calculate the remaining basis in a component of the building, you might want to take advantage of our partial disposition calculator, which is the link you have on this slide. We created this very tool for this situation, and it relies upon the producer price index in conjunction with other factors to estimate that remaining basis for you. And this is a snipped image of what we call our qualified improvement quick reference chart. It's available on our website at kbkg.com/resources. We've got a lot of tools, a lot of resources out there, but I can tell you this is our most popular download. Many of our clients love this chart and keep it handy and pass it out to their staff and even to their clients. I'd encourage you to take a look at it as it summarizes a lot of things we've talked about in regards to qualified property and bonus eligibility dates. Here's some other considerations when you're thinking about having a cost segregation study done. How long does it take? We say typically 30 to 60 days from the time all information is received, not from the point of engagement. Sometimes it takes a while to get everything we need from a client, but it's a good idea to plan ahead for tax deadlines. If you need it for March 15th or for September 15th, we recommend engaging as early as possible so that projects are in the queue for timely delivery. As far as the cost, I would say most projects, the vast majority of projects, are in the $6,000 to $16,000 range, and they pay for themselves many times over in terms of the deductions in the current year, as well as the overall net present value over the life of the property. And generally, the fee depends on the size and type of building. Have there been any additional renovation costs on top of the building acquisition? Do those renovations span multiple tax years? And for smaller residential properties, the fee can be very much lowered just by using the tool. I think I mentioned the residential cost segregator. This addresses properties that are $500,000 in basis or less. I dropped this slide in here about evaluating a cost seg provider. I definitely recommend you seek out one who is a certified cost segregation professional so that you're confident in the quality of the work that's being done. You should also evaluate the resumes and bios who are going to sign the report. And if a firm withholds that information, I'd be aware of them. Find out how long the provider's been doing cost seg studies and how many have they performed. Consider their experience with tangible property regulations. Will they be prepared to address retirements and dispositions, repairs versus capital expenditures? Consider their experience with 179D and 45L green building projects. Will they be prepared to identify those kinds of opportunities that might coexist and be discovered during a cost seg study? Consider who you want defending you if that study goes under audit down the road. Will the other company be around, much less have qualified experts to testify on your behalf? Will you have to pay extra for it? Consider the resources available to the provider. Sometimes you can have a very good small provider, but sometimes low cost and small providers don't have all the resources they need just to stay on top of changes that take place with the tax laws. So a lot of things to think about as you evaluate different companies. I've dropped in a few more slides on other tangent services that fit in that we see. I mentioned 45L and 179D. 45L is a tax credit, $2,000 tax credit for residential rental properties, and each unit has to be evaluated separately. It either qualifies or it don't. If it qualifies, it's a $2,000 credit. That's only good through 2021. Congress hasn't extended that further. We think they probably will, but for now, it goes through 2021. And then the 179D commercial deduction is for energy efficient buildings. It's up to $1.80, potentially up to $1.80 a square foot, depending on whether the building qualifies on lighting, envelope, and HVAC systems. You can qualify on any one of those three and get 60 cents a square foot for each one, but it's a permanent benefit. It does not need to be extended anymore because it was made permanent in years past, but it may change, hopefully more favorable in the year ahead. Research and development tax credit is a wage-based credit that's usually more applicable than a lot of taxpayers realize. Sometimes they think it's only available for people that are wearing lab coats and doing kind of obvious research and development, but it's much broader than that actually, and so it's an area we specialize in. And then the fixed asset review, this was much more common and needed leading up to the implementation of tangible property regs in 2014, but we still get involved in that when people need help kind of scrubbing their assets and figuring out whether they've taken advantage appropriately of bonus and places service dates and so on. So we still do those. There's my contact information. If you would like to grow your network and add me to your connections on LinkedIn, I invite you to do that. If you have questions, don't hesitate to reach out and call. I'm going to turn it back over to Caesar to explain to you how to get your CPE credits.
Thank you, Eddie. If you prefer engaging people and being social versus crunching numbers all day, our business development team is looking for CPAs or tax staff seeking a career that utilizes your social skills with flexible work from any location. You can find out more at www.kbkg.com/careers. This concludes the CPE portion of our presentation. However, for those of you who have another 15 minutes, we have a bonus presentation we hope you will watch. The following video will demonstrate two tools available on our website that may be very useful to you. The first is our residential cost segregator designed to address residential rental property with the maximum of 500,000 in depreciable basis. The second is our partial disposition calculator, which can be used to estimate the remaining depreciable basis in building components that have been retired. Please view this brief presentation and let us know of any feedback or questions you may have.
Hello, my name is Gian Pazia. I'm a principal at KBKG and a certified cost segregation professional. I'm going to be walking you through how our residential cost segregator software works. The residential cost segregator was created to provide tax preparers with a tool that allows them to prepare a cost segregation report on smaller residential properties without the need to hire a third-party cost segregation engineer. By using basic information and allowing the building owner to fill out a simple survey about the property, our software provides a detailed cost breakdown categorized by tax life that can be used for income tax depreciation purposes. This is accomplished by using empirical construction cost data and proprietary algorithms written by the KBKG Cost Segregation Engineering team. The primary goal of our software is to identify all the property-related costs that can be depreciated faster. Typically, you depreciate these with a 5, 7, or 15-year tax life. And then the secondary goal of the residential cost segregator is to establish the depreciable tax value for each major building component that is likely to be replaced in the future. The residential cost segregator is available for residential rental properties up to 6 units with a depreciable tax basis of $500,000 or less. So that's typically the purchase price less the land value. The benefits on average are greater than $20,000 of additional deductions in the first 5 years. Before you even log into our software, you can quickly generate an estimate of potential tax savings for your client. From our website, simply click on Estimate Your Tax Savings. All you need is the depreciable tax basis and the approximate date the property was acquired. So I'm going to use an example here of $300,000 and placed in service date in 2014. Once I hit the preview button, you can see a nice estimate that you can forward to your client. In this case, for a $300,000 property, the additional deductions they could expect in the first year are between $17,000 and $25,000. Now you can download this and forward it to your client and get them to agree to move forward with a cost segregation report. Once your client agrees that they want to move forward with the cost segregation report, you simply log into our residential cost segregator software, and from the dashboard, you can click on the New Report button. You'll then see our application open a new project. From here, you have the option to enter in as much information that you know about the property, and then send your client an email invitation link to fill out the rest of the survey about their property. So let's say you have their depreciation schedule in front of you, and we know that the street address is 123 Any Street in Chicago, Illinois. And we know the depreciable tax basis is $300,000, and it was placed in service on 7/1 of 2014. Now I can send an email invitation to my client who owns the building, and they can fill out the rest of the form. go ahead and type in their email address, and they'll get an email telling them exactly what they need to do. Once your client clicks on the link, they'll see a very similar screen, and now they can finish the survey. The key to this software is how simple it is for your client to answer these questions. Let's continue by walking you through what your client sees. We'll go ahead and select a residential single family that's 2 stories. We'll use a building square footage of 2,000 square feet on a 4,000 square foot lot. We'll say it has a stucco finish and let's say no basement. We can move over to the interior tab and go ahead and select that there's 3 bedrooms, 2 bathrooms, there's some fire sprinklers, and then you can select what kind of flooring is in each room. We'll go ahead and select vinyl. We'll say the bedrooms have carpeting. We'll next move to the interior features where you select if it has heating and cooling or both, and then what kind of heating or cooling system it is. So we'll just use a central ducted system. We'll say that there's 6 ceiling fans and that there are horizontal blinds on the windows. Under the appliance section, you simply check the box for which appliances came with the property when you purchased it. We'll then move to the exterior section. Here you describe whether it has a parking garage and whether it's attached or detached. We'll go ahead and say it's attached and there's 2 spaces in that garage. Then you select how many parking spaces there are outside in the driveway. So here let's say there's 3 spaces in the driveway, and under site improvements you simply check what kind of features you have. So we'll say that there's landscaping and we have a patio. In this last section you have the option to input the lineal feet of any kind of walls or fences on the property. So I'll go ahead and say there's a wood fence 100 lineal feet on the property. And on that last screen, it's simply a review screen so your client can do one final review before they submit. Once they're good with all the information, they go ahead and click submit, and that sends an email back to you telling you that the information has been input. Now the next time you log into the residential cost segregator, you can look on your dashboard and go ahead and resume the last property that you were working on. Once you've reviewed all the information and you're ready, you simply click the calculate button to generate your report. And now we have our cost segregation report breakdown that can be used to file your tax return. The first page is a nice summary of how much additional tax deductions were created and how much that means to your client. In this case, $24,000 of additional deductions in the first year were created, and if they're able to use all those deductions, that translates into $9,674 of tax savings in the first year. On the report's second page, we'll see the complete building construction cost breakdown. You can see that each item the owner indicated from the survey is reflected in our results. For example, the fire sprinklers, the landscaping, and there was also some carpet in the bedrooms and so on. Each major cost is organized by the appropriate tax category, giving you all the information you need to file the tax return. And the final page is documentation for your file on all the inputs that the owner filled out for the property. You have the option to save this as a PDF and send it to your client, and also export the results to Excel in a format that can easily be imported into most tax depreciation softwares. The tax preparer has the option to use KBKG's online 481A adjustment calculator. The results from the residential cost segregator can be immediately imported into the 481 calculator, so it only takes seconds to generate the required attachment schedules for the Form 3115. I'll go ahead and click that button just to show you how simple it is. And as you can see, the results from the cost segregation study have been immediately imported into our 481A adjustment software. You simply need to fill out the rest of the information, which includes the taxpayer's name, identification number, and accumulated depreciation on the original asset. For more information on how to use our 481A calculator, you can view that demo online on our website anytime. The next thing I want to show you is our partial disposition calculator. To access this, you simply go to the KBKG Solutions dashboard, and under the Calculator section, you click on Partial Disposition Calculator. The Partial Disposition Calculator was created to help estimate the unadjusted depreciable basis of a building component that has been disposed in order to claim a partial disposition deduction. The calculator uses a discounting method which is allowed by the IRS using the producer price index. We take the current replacement cost of the new component and discount it back to the old component's placed in service date, all while considering the condition of the respective component at the time it was acquired. This is accomplished by considering the component's normal life and effective age. Let me walk you through an example. Let's say your client purchased or replaced windows in their apartment complex and spent $200,000, and the replacement occurred in the middle of 2015. We know from the depreciation schedule that the building was originally acquired for $3 million, and the original acquisition date was in 2008. From the depreciation schedule, we can also pull the accumulated depreciation that has occurred on the building. So I'm going to go ahead and input just any number for example's sake. We'll say the accumulated depreciation is $300,000. We then go to the component section and type in any kind of component. In this case, we'll type in Windows, and we'll see different options for Windows. I'll go ahead and select vinyl windows, and you'll see that the software automatically pre-populates that the normal life of a vinyl window is 24 years. It's also calculating that the windows lasted 7 years from the time we purchased the building in 2008 to the time we replaced the windows in 2015. So what the software is doing is calculating the effective age of the windows at the time it was acquired. Using this information, we can apply the appropriate condition factor to the windows. So I'm going to go ahead and click Calculate, let the software run its calculations, and what you'll see is that the result is that the adjusted cost of the component removed, in this case windows, is $80,682. That represents the value of the windows in the old building that you can claim a partial disposition deduction on. So what our software does is it goes ahead and calculates the accumulated depreciation on the windows, and then of course calculates what your regular federal tax deduction should be. For more information on how to use these tools, I encourage you to register for a free account on the KBKG Solutions website. There you can click on more in-depth video tutorials to answer all of your questions.
Thank you for joining us today. This concludes our presentation. Have a wonderful day.